Good afternoon, everyone, and welcome to another session of Unlock the Stock with Capital Appreciation and Spear REIT. As you know by now, this platform is specifically designed for retail investors to get to know management and their companies a little better. Unlock the Stock would not be possible without our technology partner, Lumi Global. Their website is lumiglobal.com, and you can visit it to find out more about their integrated AGM and investor presentation solutions. As always, our hosts will be the Finance Ghost and Mark Tobin from Coffee Microcaps, and they will be facilitating the Q&A session in the respective breakout rooms. This event is sponsored by A2X, a stock exchange playing an integral part in the progression of the South African financial markets. A2X is the second largest stock exchange in Africa when measured by market capitalization, with 169 securities listed on the platform, including 28 of the top 40 stocks, with a combined market capitalization of 9.3 trillion rand. There is no additional cost, risk, or additional regulation for a secondary listing on A2X, and it provides the issuer's investors with the opportunity to save money. The team at A2X are proud to be partnering with Unlock the Stock. Just as it unlocks value through insight and key analysis, A2X unlocks value for stocks listed on its platform, helping to drive the market forward. We would really like to welcome back again both companies, Capital Appreciation, represented by Bradley Sachs, the CEO, and Alan Solomon, the CFO, and Spear REIT, represented by Quentin Rossi, the CEO, Christiaan Barnard, the CFO, and Kim Pfaff-Karg, the Chief Investment Officer. They will take you through the respective presentations and answer questions. Before we start, just a few housekeeping rules. Each company will do a 12-minute presentation. You will then see a button at the bottom of your screen that you can select the respective breakout room that you would like to join. In that breakout room, you can ask questions to management by typing them into the chat function at the bottom of your screen. Each of these breakout room sessions will be 20 minutes long. The event will be recorded and available on our Unlock the Stock YouTube channel. Once you're in the breakout room, you will see an email address for the company. If you would like to be added to their contact database, please reach out to the company. I'm now going to hand you over to Capital Appreciation. And Brad, thank you for waking up so early in the US to do this presentation for us. So if you're ready, you can share your screen and go ahead with your presentation, please.
Okay, so thank you very much for having us again. And I have been instructed to keep this to no more than 12 minutes. We have a lot of ground to cover. And as a result of that, I will talk quickly. But in addition to talking quickly, we will list this presentation on our website, and you can go back and have a look at it at your convenience. So I'm having a problem with my screen. Okay, I got it. So Capital Appreciation has two divisions. We have a payments division, which has three companies in it: African Resonance, DashPay, and Layup. Glass, which is an initiative under DashPay, is a really cool product, which I will talk about. In software, we have now four divisions. We have Synthesis, which is the company that we acquired when we first listed. We made an acquisition about 1.5 years ago called Responsive. And we just concluded the acquisition of a new company called Dariel Software. And so we're very pleased with the extent to which we have grown. Our international operations have also continued to grow, and you will see that in our financial results. Our investment case is actually quite simple from our perspective. We are in a sector which has very strong secular growth trends. We think that the market opportunity for us is substantial, be that domestically in South Africa or internationally. We have become a trusted partner to some really great clients who are blue chip in their nature, who have the capital to be able to spend on technology. We have a track record which precedes us when we enter conversations. We have taken a view that there needs to be a deliberate focus on the future as well as on current performance. And as a result of that, we have continued to invest in the business. In this most recent financial year, we spent 132 million Rand on growth-related initiatives. 109 million of that was expensed through our income statement. It obviously has a short-term effect on our earnings, but we believe it was a wise investment for the future growth, sustainability, and longevity of the company. We are cash generative. Our business models are resilient even in difficult markets, which South Africa is certainly going through at the moment. We have no debt at all. We are sitting with about 500 million Rand of cash, and we have the ability to deploy that on growth-related initiatives for organic growth as well as acquisitive growth, and we have done that to date. In terms of our clients, this is a snapshot of some of the companies that we service. We started in the financial services sector and have started to expand into retail, healthcare, telecom, and logistics. The major driver of the demand for technology is that the world is becoming digital. COVID demonstrated the weaknesses in our supply chains. It demonstrated economic compacts that we had all sort of agreed were acceptable, but really were weaknesses. And digitalization has helped fill the gap and transition us away from that. It's happening in the payment sector. It's happening in every walk of commercial activity. And as a result of that, we are seeing really great demand for everything that we are doing. In terms of capital appreciation, about 50% of our revenue today comes from software and about 50% from payments. EBITDA contribution, payments is a much larger contributor. We did just a hair under 1 billion Rand of revenue last year, and from a company that listed in 2015 with 0 revenue, we are pretty proud of that. In terms of our contribution to South Africa, our employee count has gone up 3.5 times since our listing, and we are now operational and delivering services in more than 20 countries around the world. The entire group is reflecting growth, whether it's from the payments sector, where we are having growth in our terminals, whether it's in the amount of annuity revenue that we are generating from our payments business. Our software division had revenue growth of more than 58%, and our international division was up 177%, albeit off a small base. There are 4 factors that characterized our activities in the last financial year: exceptional revenue growth in software, which is what I've already mentioned. The payments division, even in a difficult economic environment, put up a very resilient performance. There was a substantial amount of investment in growth, which I've already mentioned. And we did take an expected credit loss provision related to the investment that or the capital advance that we had made to an initiative called GovChat, which we were doing as part of our enterprise development activities. So in terms of the 109 million Rand that was expensed, here is a quick snapshot of this. You can go back and look at our website and you can look at it in more detail, but we have itemized it and we think that these are all good investments for tomorrow and the future. In terms of our business overall, we have been a very strong dividend payer. We are cash generative, and we will continue to pay dividends as and when we think the need arises. We do not have a fixed dividend policy, and over the last 6 years, we have returned in excess of 425 million Rand to shareholders by way of dividend. In terms of the services that we offer in payments, the areas where we distinguish ourselves are the ones that are they're surrounded by the blocks. We are a software provider as it relates to payments primarily, and we do a tremendous amount around the asset management of a payments estate. And those are value-saving and enhancing services that our clients truly appreciate, and where we distinguish ourselves from some of the competition. In terms of demand for terminals, we continue to see the demand as growing in 2021. The growth of terminals deployed in the Middle East and Africa grew by about 36%. We think this will continue. There are a number of factors: enhanced technology with increased functionality and more sexy and cool terminals. There is a regulatory compliance issue to ensure that security standards are complied with, and there is a movement away from existing 2G and 3G networks that require modernization. We have developed our Halo product, which continues to innovate, and from a single solution being an SDK, we now have a number of other iterations of it, which we are taking to market. The initiative that we invested in is a company called Layup. Layup is a save now, buy later initiative, as opposed to buy now, pay later, which is a credit product. It is a startup, but it is starting to have tremendous results. If any of you are on LinkedIn, you would have seen a recent sign up of Pick and Pay Clothing as a proof of concept, which is going tremendously well. And so we are very proud of the work that Layup is doing. In our software division, we have a number of initiatives and services within there. The ones that are most interesting, which I'm going to focus on now, is cloud, which uses AWS primarily, but also has recently expanded into Azure and GCP, which is Google Cloud Platform, and intelligent data. And intelligent data is an interesting area because it builds on the need to have a robust cloud infrastructure. So the cloud sector is growing at a tremendous rate. The reasons for doing it, as revealed by McKinsey, talk about more than $1 trillion of economic value to be unlocked by appropriate cloud deployments. And cloud is something that is an absolutely essential component of AI. I'm sure many of you have heard of ChatGPT, ChatGPT-3, GPT-4, OpenAI. All of that requires large cloud infrastructure and deployments. So we are very focused on that. Well, what does it really do for you? Well, this is a picture of our dog. The text on the right-hand side is a poem that ChatGPT wrote about our dog Lucy, as composed by a woman, Diane, who is probably 65 years old. It shows you how functional it is for somebody who is a little bit of a Luddite, who doesn't use a lot of technology. She can use it quite comfortably. The growth of ChatGPT is astonishing. Within a short period of time, in 2 months, they had more than 100 million users worldwide. We have acquired Dariel, which is a company very similar to Synthesis and allows us to expand into other areas. So we are very pleased about that. We have shown use cases in the past, which I'm not going to dwell on because we are running out of time. But we have growth strategies in payments and in software. And ultimately, we think that our prospects are pretty sound and solid. We are pretty excited about what the future has to hold. We think as an organization, we are well positioned. We have an excellent management team. We have the financial capital to be able to do it. We have a track record of innovation. And we are in sectors that have demonstrated the need for our services. both domestically and internationally. And I think our track record in that regard speaks for itself. On that basis, I have reached my 12-minute mark. Thank you very much for listening. I will be available for questions in the breakout room.
Thank you so much, Brad. It's wonderful to see all this growth from even the first time that you presented on Unlock the Stock. So thank you very much. Qunitin and the team at Spear, I'm going to hand over to you. If you could share your screen, please.
Good morning, everyone. I think our screen is, can you see the screen presentation?
It is perfect. Thank you.
Excellent. Morning, everyone, and thanks for taking time to view our presentation today. And thanks, everyone, for that was involved in organizing this. I'm going to share this presentation today between myself, Christiaan, and Kim, and we'll just move on quickly to the table of contents of what we'll be talking about over the next 12 minutes. And we can just move on quickly to the introduction. Spear was founded in 2011 as a private equity business, back in its genesis, also exclusively focusing on Western Cape real estate focused business. We have prided ourselves in always being extremely close to every single one of our assets. To not be further than 1 hour away from every single one of our assets has always been part and parcel of our operating strategy. We, as a REIT, are the only regionally focused REIT that's listed on the Johannesburg Stock Exchange. We obtain our specializations through Western Cape only investment and our diversification through investing across the industrial, commercial, retail, and mixed-use asset base. Spear listed in 2016 on the JSE with a portfolio of approximately 1.4 billion. So over the years since listing, we've grown the portfolio by an additional 3 billion rand to about 4.4 billion rand, and that's across 426,000 square meters of GLA with a distinct bias towards industrial and multi-let industrial parks. Spear is a fully internally managed REIT. What that means is that we do all our financial management, development management, property management, and asset management internally. We have all the skills with a proven track record to do that. We have got growth ambitions to become a meaningful mid-cap REIT. But given the fact that Spear is no manco, so there's no incentive for us to just grow for the sake of growing, we have an ambition to grow the business to about 15 billion over the next couple of years, but it's not a target, it's purely a strategy, as we believe that this will expand our investment universe or investor universe once we become indexed fund. The team, from an executive management perspective, is led by myself, Rossi, our CFO, Christiaan Barnard, our COO, Tobin, and our Chief Investment Officer, Pfaff-Karg. Saying a little look of our growth journey, the genesis, as I mentioned, starting out with a 72,000 square meter property portfolio in the Western Cape with the Cape Metro bias of about 354 million rand. We grew that business up until 2016, where there was a distinct opportunity for us to bring to market a Western Cape only focused real estate opportunity with no exposure to any of the other regions in South Africa, and with a management team that's got a proven track record over quite a number of years in a variety of other listed property funds. From 2016 up until 2023, you can see the most meaningful growth in the business took place in 2018. Capital was in great supply. Trading yields were a lot better than what they are right now, a lot lower, and market ratings were a lot stronger. Hence, we were able to raise capital at probably around a 5 to 7% discount to our NAV, which is not the current trading environment. So having a look at the mission and our strategy. Since inception, our mission has been to be the leading Western Cape focused REIT listed on the JSE, to grow our distribution per share ahead of inflation on an annualized basis, and to operate within the top quartile of our peer group. Now, I'm extremely pleased that our team has delivered on this mission statement. And this mission statement is something that may not always be achieved every single year, but to date, if you take COVID out of the equation, we have achieved this in a very, very tough economic environment. And I think that the regional focus and our proximity to our assets is some of the key points to achieving that strategy. On an operating context, we've always prided ourselves on being value investors and using asset management initiatives to strengthen net cash flows. We've always been an authentic dividend-paying REIT, a sustainable dividend-paying REIT for that matter, having returned approximately since listing 937 million rands worth of dividends back to our shareholders. We own high-quality industrial, convenience, and retail assets in excellent locations. And if you have a look at our occupancy rates, it's testament to that. We have a proven track record of prudently recycling capital from non-core disposals into larger assets with longer-term leases. We have a very active asset management approach and early engagement strategy, which has allowed us to maintain both strong rental growth, strong asset value growth, and high occupancy rates throughout the portfolio over the years. Furthermore to that, we've operated with a strong balance sheet. Given the fact that we do not take unnecessary risks, we've always maintained that our balance sheet has been strategically between a 38 and 43% loan to value at any given time. Currently, we're operating at a lower loan to value than what's within our strategic band, but that kind of fluctuates with the market, which is kind of akin to the fact that interest rates are where they are at the moment. Then in terms of our investment strategy, we've got 4 pillars to our investment strategy, which are informed by the fact that we exclusively invest in the Western Cape. We have a strong industrial and retail bias. We follow a less is more approach of owning fewer assets with assets of higher value, given the fact that we have 100 million rand minimum ticket size in terms of asset type, unless it's specifically strategic for us. We take a quality over quantity approach. For us to be acute asset managers of our assets, we need to be able to really get into the nuts and bolts of these assets. Therefore, the quality over quantity comes into play. And what we don't take into our valuations is that we have approximately 150,000 square meters of developable bulk in our portfolio that we don't attribute any value to, which is a pure investor NAV unlock over the course of the next 5 to 10 years. And we have patience. We're a young management team with a lot of energy, a lot of great people within our business that are here to unlock value for us. And that value will be unlocked through the 4 pillars being acquisitive growth, which will probably be the most predominant growth vehicle for our business. The second will be the disposal of non-core assets and recycling that into strategy-aligned assets. The third will be strategic redevelopment of existing portfolio assets to create incremental rental growth on those redevelopments. And the fourth will be, at a smaller scale, development growth, given the fact that developments do come with their own level of risk. I'm going to hand over now to our CFO, Christiaan Barnard, to just take you through the salient details.
Good morning, everyone. I'm quickly going to take you through some of the high-level stats. Obviously, our information is always available publicly, and there's a lot more detail on the websites in a lot more complex formats, but this is a quick view of the company. This is as reported at February 2023, so it is slightly outdated, and we have released a Q1 update with some more up-to-date information, but this is still very relevant and, as always, very simplistic in terms of the business. Spear has 28 assets at a value of 4.22 billion, an average property value of 148 million, which gives you a 10,160 rand average property rate per square meter. Our in-force escalation is at 7.4% over GLA of 409,000 square meters. Post our year end, we did acquire a fantastic new industrial asset, which has increased our GLA to just over 425,000 square meters. Our occupancy at year end was 92.18%, which has also increased post year end to above 93%. Our weighted average lease expiry is 27 months, and our average rental is 98 rand per square meter. For the past financial year ending February 2023, we had a collection rate of 98.61%. And I think one of the most meaningful metrics for the REIT is free cash flow to be generated, which we did. We generated 43 million free cash flow from operating activities. That's post paying all expenditure, all interest, all dividends, everything. We generated free cash flow to utilize and reinvest within the business. In the past financial year, we generated a distributable income per share of 82.14 cents per share. After applying an average payout ratio of 92.45%, we paid out a dividend of 75.97 cents. Our SA REIT cost-to-income ratio is 43.45%, and our SA REIT administrative cost-to-income ratio is at 6.5%. Our tangible net asset value is the R11.47, which just shows you what level of discount our share is trading at the market. That increased by 1.5% from the prior financial year from R11.30. In the past financial year, we did embark on acquiring back assets of shares in the market, and which assisted in increasing our TNAV by 0.12 cents per share. Our current loan-to-value ratio is 36.30%, of which plus minus 54% is fixed. Our average expiry is 30 months of our debt in our portfolio. Our average cost of debt is 8.66%. Average fixed cost of debt is 8.18%, and average variable debt is 9.05%. Now, as you're all aware, this is at Feb 23. Post year end, the SARB has been quite naughty and has continued to increase rates. So this has changed, but this is publicly advertised in our Q1 update. And one of the main focus factors within the business to mitigate continuously increasing rates. Then just a little bit more on collections, as we do as a rental collection business. At the first and foremost, we built 574 million rand in revenue, of which we collected 566 million as when this report was written, which gave you a collection rate of 98.61%. This has post-year increased to well over 99%, and we've always maintained a well over 99% collection rate, given that we have a very small expected credit loss ratio within our portfolio. I will now hand over to Kim to take you through a bit more portfolio information.
Thank you. And these are our top 5 properties by value, which account for approximately 50% of the total value of our portfolio. This reflects our less is more approach. We prefer to own fewer assets, but assets of higher value. Firstly, we have Pfaff-Karg, which is an 86,000 square meter multi-let industrial facility in Wellville. Table Square Shopping Centre is a 31,000 square meter convenience retail centre located on the periphery of the Century City precinct. 2 Long Street is a 25,000 square meter multi-let commercial A-grade building in the financial hub of the Cape Town CBD. It also happens to be the head office of Spear. Liberty Life Building is an 18,000 square meter premium grade commercial building located in Century City. As announced on SENS recently, we have disposed of this asset and we expect it will transfer towards the end of this year. And then we have Northgate Park, which is a high quality 17,000 square meter commercial building, which is strategically located between Cape Town CBD and Century City along the N1 highway with good visibility. Having a look at the sectorial split by value, revenue, and gross lettable area, these numbers are reflected at our year-end, which was February 2023. As mentioned by Christiaan before, the value of the properties is 4.2 billion, 28 properties, and total property revenue of 574 million rand per year. As at year end, our property occupancy was 92%. That has now increased to about 93.2%. The gross lettable area, again at year end, was around 410,000 square meters, of which the lion's share is industrial, representing 56% of the total gross lettable area. We have now acquired the island, which is a logistics industrial facility in Tobin Island, which is another 20,000 square meters. From a sustainability point of view, we adopt a people, planet, profit approach to our ESG strategy. We are currently generating 5.4 megawatts power, and as we expand our solar panels at Pfaff-Karg and Sable Square, we will be generating almost 8 megawatts. Approximately 54% of our assets are covered with solar, which will increase to around 59% after our various installations. We have around 18,935 solar panels across our portfolio, which is deployed on a 3-pronged approach, either in terms of a self-funded or CapEx model, the roof rental model, or a finance model. Over the total Sphere property portfolio, 15% of our power is currently being generated by solar panels, which will increase to almost 25% in the near future. Important to note is that 20 of our 28 properties, 26 of those properties are supplied by the City of Keyter, which provides a further protection against load shedding. Property valuation. When analysing our properties on a rate per square metre basis, you will notice that our property portfolio is conservatively valued, with the average industrial property being around 5,800 rand per square metre, the average office property around 16,000 rand per square metre, and the average retail property around 14,000 rand per square metre, are significantly below our investment costs. As Quintin mentioned, we attribute no value to additional bulk, which represents considerable upside in the Sphere portfolio. On average, our average property value per property, per asset class, are all well above our minimum threshold of 100 million rand per asset. Our portfolio has fared well within the challenging trading environment, with a like-for-like portfolio valuation increase of 25.3 million, representing an uplift of 0.64%.
Thanks, Kim. I'm just going to bring us to a landing. I'm aware of time. So just to give you our view on the outlook. As a regional business, we believe that real estate fundamentals have continued to shift on a geographical basis to the Western Cape as a result of immigration and business relocations, just given the overall infrastructure. We've seen a material infrastructure investment across the Western Cape take place by both local authorities and provincial governments. Our view is shared by many that investment capital follows good governance, clean audits, the ability to actually execute infrastructure investments across the province. And I think these are key imperatives that the governing party of the Western Cape and the local authorities throughout the Western Cape really have taken on. Load shedding is a clear and present threat to any operating business in South Africa, as we've seen the results being reported by many companies. But what does encourage us is that the City of Cape Town has really taken the bull by the horns. And by the end of 2024, we do anticipate another 500 megawatt of dispatchable power being available in the grid that will effectively protect City of Cape Town customers from stage 1 to stage 4 load shedding. And as Kim mentioned, 26 of our 28 assets are supplied by the City of Cape Town. Our growth bias will be focused on multi-let industrial, retail, industrial warehousing, and mixed-use assets going forward. We have adopted a three-pronged capital allocation approach to create organic, inorganic, and NAV growth for our shareholders. And we'll obviously focus to continuously reduce our vacancies across the portfolio in the year ahead. What do you get when you invest in our business? You get exposure to Western Cape real estate, which is expensive to buy directly, but also you get exposure to a great management team with a great track record. You get a conservatively valued portfolio. Management and the board have got strong shareholder alignment in terms of ownership. We still own 30% of this company. We've shown great rent reversion stats in our Q1 update with an in-force escalation of about 7.4%. We have a simplistic capital structure, no exposure to cross-currency interest rate swaps. We've got an easy-to-understand income statement and balance sheet. We are really good capital allocators, as you've seen in the past, how we've redeployed capital. We have measurable ESG strategies in place, as mentioned by Kim, and we've got a proven track record that our asset management initiatives and our hands-on property management initiatives will prove again that we are one of the top REITs in South Africa. We are small right now, but with that small focused strategy comes great growth opportunities for us as a business. Thank you very much.
Thank you very much, Quintin and the team for that. I'm going to just ask everyone to go straight into the breakout rooms. We've run over just a little bit. So please choose your breakout room and enjoy throwing the questions at management. Thank you very much.
I'm just going to give it another second or two for people just to come across, but I'd just like to reiterate Vanessa's comments at the start there. Thanks very much for Brad for joining us from New York. It's 6:37 a.m. Brad's time, so it is very early. So thanks for making the time. And I just also want to point out, in the interest of disclosure, I'm also a capital appreciation shareholder. I've been for a few years now. So I just want to get that on the record before we start with questions. If you have any questions, please just type them in the chat section, and I'll get to them. But I'll kick off maybe with the first question. Brad, we skipped through the slides quickly, but one of the things I wanted to talk about was the new rental model for the terminal sales. Previously, we kind of talked, the rental model was kind of running off, and it was a few of the banks that were keeping it going. But now you've switched tack a little bit to kind of provide that offering to people. Can you just talk about that switch, to getting, I won't say getting back into rentals, but maybe not letting the book just kind of completely run off, and having that dual offering of buying the terminal outright versus the 3-year rental model?
Yeah, so Mark, the decision is not ours. Ultimately, it is our customer's decision as to whether or not to buy the terminal or to rent the terminal. We are lucky enough that as an organization, we have the capital to be able to provide a rental solution if that's what they like. But it is their decision as to how they want to use their capital, whether or not they want to use a CapEx budget, in which case they'd purchase the terminals, or whether they want to use an operating expense budget, in which case they will rent the terminals from us. In the rental model, we do it on a fully burdened basis, which means that we provide a lot of the incremental services around the estate that are otherwise purchased on an a la carte basis by the bank when they purchase the terminal from us. And so over the life of the rental term, and sometimes they could be as long as 5 years, we would end up providing them with lots of services at a really good overall return on investment for us. So we don't mind which one they choose. It does affect the composition of the income statement in the short term, because we would generate a margin on sale as a one-time event versus recognizing and generating a contribution to revenue and profit month on month in the rental model. So the economics to us are good under the rental model, but it does change the shape of our income statement a little bit.
Yeah, and also the cash flow statement where you're getting, I presume, a monthly debit order coming through as opposed to a one-time sale invoice.
Correct.
Just if we can talk about the estate around it, I want to talk. If we stay on the payment side of the business, the maintenance and support services and the transaction services revenue. If you add the two of them together, it's quite a hefty chunk of revenue now within the payments business. Is from a margin perspective, is that better than the sales and the rentals? And then over time, as the estate grows, and more services and more offerings come through, because I know that's a focus for the payments business. Should we continue to see that growing at a pretty nice clip, the maintenance of the transaction services revenue?
Yes, that's certainly the intention. And so what we are able to do with the scale of the estate is to take advantage of economies of scale. And we have operational efficiencies that you derive. A lot of the stuff that you have to provide, if you have a small estate, is replicated when you have a large estate to manage, but you've got a much larger number of terminals to amortize that cost over. So we continue to provide incremental services against an enlarged estate, and that will generate enhanced margins for us. So we are pretty pleased with where the estate is overall, and we are somewhat agnostic as to whether or not the institution wants to purchase the device from us or would want to lease a device from us, given the way that we do it. And we'll be responsive to the institution's need.
Okay, great. We've got a couple of questions in already. Let me just get them up in my DMs here quickly. Let me just see here. I know we had, let's talk about GovChat. We maybe just, I know we skipped over it quickly, but the impairment, I think, was 70 million. Maybe Alan, this is for you, or the provision. Maybe it's not an impairment to get the wording right. But there is, depending on what happens with the case against Meta, the possibility of some kind of recovery there. So maybe let's just talk about the amount and, you know, where GovChat might end up if we cast our minds forward 12 or 24 months.
No, you're correct. The actual, we've actually provided against the loans that we've provided. So we have not written off the asset. It still sits as a gross amount. Obviously, the net effect is that we showing a 1,000 Rand carrying value post the provision. There's obviously underlying value. You've raised the point, the fact that there is certain potential outcomes coming from the Meta matter. There is also, we have security of the shares in the company. We also have the security and the pledge of the underlying intellectual property, which has got quite substantial value. The platform itself is working effectively. Lots of active users and lots of messages are going through daily, weekly, and monthly through the platform. And the actual costs that we are continuing to fund through the funding mechanism with the business risk practitioner are modest in their own regard, but there are some costs, but not material in the context of the way going forward.
Okay. Brad, a question here on the payments, and to my second question on the services. Can merchants get incremental services from other providers? So, you know, they might buy the terminal from you and take up some of your offering, but could they take up, you know, additional offerings through that terminal? As you know, somebody might come along and say, hey, look, we can give you a great, I don't know, CRM system that can run over the top of your terminal, but it mightn't be a product from capital appreciation.
So the answer is it depends. An example of that is layup. So layup happens to be within our family, but we have deployed layup on some of the DashPay terminals. We are also deploying it on some of the terminals that we have placed with some of our bank customers. There have been terminal providers that have approached layup and said, can layup be deployed on our terminal? One of the strong characteristics of our business is that we are fundamentally a software business. Although we provide terminals, the magic of the capital appreciation payments offering is in the software that we provide around the device and the management of the estate. So we have built APIs and capabilities for other parties with our consent. They can't do it without our consent because we sign the security keys on the terminal. With our consent, could connect through our APIs. And it is through that mechanism that we have an economic interest in the terminal being very productive. Whether it's with our software or other software, it is an economic benefit to us.
Okay. Then a question on the Netherlands business, which is you know, I guess been I think it's its first full year as part of the capital appreciation business now. Maybe just some general comments you know, around the international expansion. You touched on it in the slide, you know, it's growing, albeit off a very low base, but maybe just talk about, you know, the that business in the UK, you know, servicing international customers from South Africa, and, you know, the cost advantages of that, especially if they're in Europe, and, you know, that whether they in the synthesis business, I'm presuming more than the payments business, but how that South Africa versus international growth, either organically or inorganically, is kind of being debated at a board level?
So what we were able to determine before we set up the Amsterdam office is that we were starting to operate in a number of jurisdictions around the world, helping South African clients go into different markets, and as a result of that, being exposed to and approached by international companies asking us to do some work for them. We have a relationship with a consulting firm out of Singapore that did a lot of business prospecting for us, and it is the Singapore-related activity that has accounted for a lot of our international growth. We determined that given the competencies that exist within our software business, we can hold our own with the best in the world, and we can provide those services at a cost which is less than the pound, dollar, euro equivalent that many of the international competitors provided at. And we provide those services out of South Africa. As a result of that, we had thought it was a good idea to have a beachhead in Europe. Amsterdam is a fintech hub, and one of our lead technologists was happy to emigrate and go and set up that office, which he has done. It has been a successful entry into that market. We have found there being a reasonable appetite for some of our service offerings, including the Halo.payment capability in the UK and Europe. And so we will continue to pursue that, with the majority of the work being done in South Africa, generating hard currency revenue for the group.
And then a question on, I guess, staying ahead of competitors who are in the same focus area. We had PBT on here last week, who I'm sure you come up against from time to time in the Synthesis business, but maybe just talk to that in terms of, whether it's PBT or Accenture or Delight Digital or, some of these other consulting firms, how, and it's all, I guess, down to the people and the skills, how are you as so we don't have Michael here to maybe talk about this, but how are you keeping ahead of competitors or staying on the very front foot? You talked about ChatGPT, there seems to be a new thing every week coming out in the technology space that, firms like you need to be, well on top of, because customers might want to utilize it either now or in 6 months from now.
So staying abreast and current with the technology is an important part of what we do, and one of the elements for which the Netherlands office is responsible. We interestingly have not competed against PBT, and they've done an excellent job in growing their business over the period of time that I have watched them from afar. The interesting thing from our perspective is that the market opportunity is so large and the demands for our services are so substantial that there is more than enough room for all of these competitors you spoke about in the marketplace to compete. And ultimately, the competition is based on competence. We spend a substantial amount of time on ensuring that our team is well trained, well abreast of the trends. We continue to invest in their ongoing education and currency of their skills, and is something that we have as a high priority amongst the management team. So that is something that we compete on. We compete on our skills and our innovation. And so far, we have done more than okay, more than our fighting weight.
And I can't remember if it was in this deck, but I'd encourage people to go back and look at some of the other decks that Capital Appreciation put out, where you talk about all the different Amazon licensing and certification, which obviously people need to get in order for the company to get. So I think that speaks to that question. I do just want to touch on one of the projects, which was the PayShap project, which a lot of people would have got notifications from their banks that has been launched earlier this year. maybe just talk us through the genesis of that project. And, you know, was it a purpose-built project style project, or does, you know, CTA still kind of make money off of every transaction, or a licensing fee that Bank Africa are kind of paying to use the platform?
Well, that's a great example of where our competence and our reputation precedes us. Bank Africa needed to migrate to a cloud-based infrastructure, and they had a direct relationship with AWS. And when approached, AWS recommended that Synthesis do the design and implementation work for the architecture of the PayShop service, which is what we did. So our reputation was good enough for AWS themselves to recommend us to that project. Bank Africa is an organization that we've had a relationship with for some time, so we weren't an unknown to them, but it is nice to have that endorsement. Our work there was primarily related to development of infrastructure for the migration to a cloud-based architecture. We don't have an ongoing participation in the transactions, but we do provide managed services for them for that architecture, which gives us ongoing annuity revenue as a result of it. So we have a vested interest in its success.
And I'm sure there'll be upgrades and things to come down the line once it gets a bit more traction. One final question, Brad, because I know we're pushing up on time. A question on the Halo tap-on phone products. You know, just give us an update on how that rollout is going out, and when I think the question is, you know, when we're going to see meaningful revenue coming from that particular product.
So Halo Dot is an enabling product. It's not an end market solution as such. It is highly dependent on the customer that Halo Dot contracts with and empowers and enables to be successful in the market. So for instance, we provided the technology to Nedbank. We didn't offer the service directly. And Nedbank has been pretty slow in its rollout of its solution called Pocket POS. That's not a function of our capabilities or the technology. It's a function of our customers' approach to the market. The same is true of many of the other customers that we are contracted with. We are dependent on their decision to roll out and the aggression with which they want to roll out. So we are somewhat beholden to them, but we continue to believe that it is a strong market and a good opportunity for us, not only domestically, but internationally too, which is an area that we're spending a fair amount of time on.
Brad, we'll, I think, leave it there. I don't think we're about to fit in one more question. And on the Halo, that thing, I think people must also realize that these are enterprise level projects across hundreds of thousands of accounts and at the banking level. So they do take time to implement and roll out. And there's a lot of work, I'm sure, that has to be done on Nedbank's side and some of the other partners before a full go-to-market offering can happen. Brad, Alan, thank you for joining us and indeed coming back to the Unlock the Stock platform. And we'll keep an eye on the SENS announcements over the rest of the year, and hopefully we will see you on this platform again in the near future.
Yeah, Mark, thanks for hosting us. Always good to take your questions.
And if we will move now back to the main room, and Vanessa will just give us an update on who we've got coming up next. And thank you everyone for joining the Capital Appreciation Room.
Yeah, I think let's do it. You'll have to forgive my voice. I pretty much sound like that road in Joburg that blew up this week. So maybe I'll start there, talking about Joburg versus Cape Town, considering I was there the other day. And the road outside the Sandton car chain looks like someone gave my toddler a whole lot of tar and asked them to go and fix the road. It's astonishing. And I think for the Spear team, a big part of the success has been obviously the Western Cape focus. I think we all know what's going on with service delivery in South Africa. So while I wait for questions to come through in the chat, the one question I definitely do want to ask is, are you finding Cape Town properties are starting to reach a point where valuations have maybe started to get a little bit hot just with the amount of capital flowing down here? And if you do get to a point where, Cape Town is actually looking expensive, because anyone in investing knows, of course, it's a function of what you get and what you pay for it. Overpaying for a good asset is as bad as anything else. What do you do in that scenario? Do you think there will always be enough opportunity in the Western Cape to find the right priced assets?
Yeah, I mean, I'll pass that ball over to Kim shortly, but I think that there is the entire Western Cape for us is an proposition. So we don't, we have a distinct focus on Cape Town, but the investment opportunity for us really is a lot broader than that. And that's the beauty of the Western Cape general infrastructure, is that we can invest all the way right through to Swellendam, Wellington, especially if we look at one of the growth strategies where we want to find some opportunities is in the agri-logistics space. So that opens up a whole host of opportunities all the way right up to the Southern Cape. As an example, some of the bigger counters on the JSE own about 26 billion rands worth of assets in the Western Cape, as an example. And generally speaking, that excludes even the private investor market, which also runs into the tens of billions of rands. And that's really where we think that we can generate quite a bit of future asset growth opportunity, is that private investor market where private investors have built up these portfolios that have got no kind of continuity in terms of management or asset management, and they possibly have some capital gains tax exposure, which can be deferred through a Section 42 asset for share swap opportunity. But investing outside the Western Cape is categorically not part of our strategy, and it never will be. But maybe just to talk about valuations, Kim can maybe comment on that.
Yeah, sure. Well, it really depends what type of property you're looking at. So the premium grade properties in the Western Cape are either very tightly held, or, as you mentioned, they're very expensive. But there is an array of different asset classes, and really one needs to dig and look. The Western Cape is quite a private market too, as opposed to other parts of South Africa where you see lists and lists of properties available for sale. The yields are where one would be wanted to buy around about 10%. The Western Cape is more about contacts, networks, and that's the space that we operate in. We're looking for those deals that make financial sense, but they're also still prime properties.
Great, thank you. I think for the sake of everyone on the call, it's also good to just dig into maybe some of those underlying segments, which you've kind of touched on and obviously talked to some extent in the presentation, but just understanding some of the way you think around each of the underlying segments, so industrial, retail, commercial. People bucket these things together, but an industrial property is everything from a small warehouse and an office through to a monumental warehouse, right? Commercial is everything from offices aimed at premium tenants right down to small offices, and retail is convenience, which I know is where you're focused, up to sort of your super regional malls. So I think it's worth maybe just spending a few minutes running through each of those, just understanding a little bit more about how you think and why, just to help investors understand what they are buying with Spear.
Yep. No, thanks. That's a good starting point. I think I'll start with industrial, and given the fact that it's the lion's share of the portfolio, our approach to industrial is quite diverse in its subsector, where our portfolio consists of logistics assets, warehousing assets, which are different because you've got logistics assets are generally kind of less coverage on a site. Your rentals are a lot higher, where warehousing, you can kind of do bulk warehousing. We also have multi-let industrial, which ranges from Mega Park, as an example, from 300 square meters unit all the way to 10,000 square meter unit, which is everybody from a joinery business to a glass toughening plant to companies that manufacture feeding systems for the poultry industry, to Tuffy black bags, to Console Glass, to Mumbo's distribution center. And then we have the bigger manufacturing tenants within our portfolio, which range from bed comfort, like bedding, mattresses, couches, bottle caps, bottle closers, milk bottles, etc., etc. So it really is a very big spread. And then the last and most recent subsector which we've acquired is urban logistics. Now, urban logistics is effectively a high-quality logistics type of asset within close proximity to a CBD, like the Cape Town CBD, that's able to either service a last mile or more of a hybrid destination / big box retail type of offering. And that particular property is the Island. The Island is a 21,000 square meter industrial warehouse, which comprises of a Virgin Paddle Club, a climbing facility called City Rock. It also consists of a distribution facility for Oggy Flooring, which is a hardwood engineered flooring company, media film services. And that's a great example of urban logistics, is they provide equipment and kit to the film industry, and they have to be within close proximity of the city, the Atlantic seaboard and the like, where they dispatch generators, lighting equipment, cameras, camera rails, etc., etc. And then we also have bicycle distribution services that service a lot of the retail outlets across Cape Town, and also a air conditioning distribution wholesaler that supplies the subcontracting market. So that really comprises a very diversified subsector of industrial. And those rentals across the subsector range from 35 Rand a square meter to 85 Rand a square meter gross, just to give you the spectrum. So we really have a very broad spectrum of industrial, which actually is in and of itself a defensive, diversified subsectoral portfolio. And in offices, we own offices in all the high-quality established nodes in Cape Town. The CBD, 2 Long Street, which, as Kim mentioned, it's a high-rise, multi-let office building. And then Century City, very strategically placed, a Waterhouse, which is a multi-tenanted AAA grade office building. And then we have in Northgate, we have on the N1 a office park with more of a tech type of tenant mix. And then in Tiger Valley, smaller buildings, 2,000 square meters to about 4,000 square meters, multi-tenanted predominantly with businesses that staff live in close proximity to those assets. And then on the retail front, we have, as you mentioned, we've always had since inception a strong bias towards convenience retail. It's anchored by 1 or 2 larger tenants with line shops, free parking, and within close proximity to a very strong residential node. So we've got Sable Square, we've got Viking Park in Thornton, and then also destination retail in Barnard Island, which services your home improvement, motor-related, as well as a small kind of convenience retail offering.
Thank you. It's a very nice mix there. There's a question that's come through. Let's deal with it now. Just asking for some elaboration on just water, ESG. So maybe let's make the question slightly broader. I don't want to spend 10 minutes on it because I've got questions about the balance sheet and that kind of thing, but maybe a few minutes around just ESG, what you guys are doing in the portfolio.
Yeah, so as Kim mentioned, we take a people, planet, profit approach. From an ESG, so we've installed now, by the end of this year, close to 8 megawatts of PV solar across the portfolio. That's going to generate about 25% of total portfolio electricity demand. Across the office portfolio, we have installed water continuity measures, everything from waterless urinals, water attenuators, pre-diluted chemicals. We have got grey water systems across key parts of our portfolio. For argument's sake, the Liberty Life building has got a reverse osmosis water system that generates its own water together with PV solar system. Number 2 Estuaries is a net zero building, so it generates its own water together with PV solar, as well as number 1 Waterhouse and 78 on Edward. And then the other leg to our ESG strategy is how we can bring people and utilize our portfolio assets to also educate the previously disadvantaged individuals that are interested in real estate. So what we've done is we've partnered with the energy company and we've donated a solar plant on the roof of one of our distribution centers in para-industrial that's occupied by Supergroup that generates approximately probably 70,000 Rand a year's worth of roof rental income. And that then funds a previously disadvantaged student from UCT to study property studies. And over and above that, we also have, if you go on to our last results presentation, you can have a look at some of the other social upliftment initiatives that we offer, that we support, ranging from drug rehabilitation facilities, facility for abandoned babies, et cetera, as part of that strategy. We're a small business. We try and turn over every Rand quite a few times. So we believe that we are being good stewards of what we have. We'd always love to do more, but I think that we've got measurable metrics that we can actually show our shareholders on how that money is being deployed and what kind of return we're getting on that capital.
Let's jump to the balance sheet, if you don't mind, and that is specifically around debts. Obviously, for a property fund, this is all super important stuff, and I always try to bring some of this up in the Q&A because people are paying extra attention in the Q&A, not always as well as they should be maybe in the actual formal presentation. So, you know, at Spear, when I looked at your numbers, I think your fixed debt ratio has come down, the weighted average expiry has also come down. So you're a little bit more exposed to this rate cycle as time is going on. The question, I guess, is, you know, are you finding that lenders, and I think you talked a bit about it in the preso, but are you finding that lenders are rewarding this Western Cape focused strategy by giving you a better cost of debt as well than you might be seeing when you benchmark other REITs? You know, just some commentary around your cost of debt and what you're doing about the rate cycle and your exposure to it.
Yeah, I don't think it's specifically they're giving it because you're Western Cape. They do very specific look at company performance and giving us better liquidity premiums. But I think it's important to note that at our debt, a majority of our debt being fixed was done in the middle of COVID, we were at historically low interest rates. Those rates are slowly but surely unwinding towards the end of this financial year and into the next financial year, and which is our key focus to obviously look at that and refix that balance sheet. Currently, where if you look at the swap curves, fixed rates currently is way more expensive than it is what the floating rate is. In the last couple of days, given the better CPI numbers and expectation of what SARBs can do this afternoon, we've seen swap curves improve to levels just below the current floating rate. So it's starting to become a better environment to refix. But as a board and management team, this has been a big discussion point, and we've been working hard and getting a fixed rate up. But we've been doing that through, rather than just going out and blatantly fixing debt and paying for fixed debt, which will cost you more and losing MPI for the company, we've actually used disposal proceeds to lower our fixed debt by settling up maturing variable debt. And what we also do is we have announced the sale of the Liberty Life building, which will happen, we anticipate September, October, which will not only reduce our loan to value, but will substantially increase our fixed debt ratio, as we will be settling a 370 million Rand debt facility on that portfolio. So we are working not only just fixing, but also using proceeds to settle, refixing. But I think we're getting to a cycle now where starting to fix that is finally becoming attractive again. We're almost there. So it's a very big focus of us. But yeah, so the lower cost of debt is a mix between historically fixed debt, which is low, and the current variables, which are quite high, which you have to manage between the two. When is the right time to fix?
Thank you. I think there's quite a lot there for everyone to learn. I enjoyed that. Yeah, Quentin,
I just want to make one comment, which is maybe a bit more technical in nature, but it's something really worth thinking about. If you have a look at our latest results presentation, you'll see that we've repurchased approximately 21 to 22 million shares over the last call it 2 financial periods. Right? Nowhere, and that's an asset. It's effectively an asset. So either we can, we have plans to cancel some of the shares, or in terms of our authority to issue shares for cash, we could, if we wanted to, issue some of those shares. That asset nowhere is reflected as an asset in a sense, because that should typically, if you look at our loan to value, nowhere does that actually reflect in that LTV. So one should actually take that into consideration. And from our perspective, when looking at the strength of the balance sheet, just how many shares do you hold as an asset in treasury? And because that would probably end up having a 250 basis point improvement on that LTV. And just to mention, post the disposal of Liberty, that's going to have about a 450 basis point improvement on the group LTV post that registration of transfer.
So let's talk about the buyback strategy, the discount tangible NAV that plagues JSE listed property funds. I mean, Spear unfortunately is no different. I did a quick Google of your share price versus the TNAV, and there's obviously a discount there, which is normal. It's no reflection really on what you guys are doing. What does this mean in terms of, the way you think about capital allocation? So obviously buybacks at a discount to TNAV are great. Does this mean you're not going to raise equity capital at these sort of levels? You'd rather recycle capital within the portfolio? I think just good for people to understand that.
Yeah, I think it's very important for us we don't believe that we're always going to be trading at a discount to our NAV, but right now the environment for us is, our benchmark. So if we have to look at acquiring an asset, which may have some element of asset management requirements, capital that we need to spend on it, et cetera, it has to then kind of be close to 11% for us to acquire that, or alternatively, because we're trading at a discount to our NAV, and because we know the portfolio as intimately as we do, we know where the pressure points are, we know where the levers are that we can pull, we could just repurchase those shares back in the market at a 11+% return. And for us, I think that whilst we're trading at such a deep discount to our NAV, our strategy from a capital allocation perspective will be to, as Christiaan mentioned, on disposals, we'll settle debt to get that fixed debt ratio up, and we'll repurchase shares with free float that we generate from operations. And until such time as we get to a point where the discount between NAV and the trading price has narrowed enough, because at the end of the day, we're still owning 30% of this business, and from an alignment of shareholders' interest perspective, we've had shareholders that have supported our business since inception in 2016, and there's no plausible reason for us to dilute these shareholders to such an extent. And also, it makes it extremely difficult for us to stick to our mission statement, which is also to grow our distribution ahead of inflation on an annualized basis if we're issuing super expensive equity.
Yeah, I fully agree. We've got 90 seconds. Can you give me 90 seconds on why reversions in the retail portfolio have been negative in the convenience retail portfolio despite Keyter's strength? Make it 80 seconds.
Okay, so there's two reasons for it. One of the leases came off a 7-year lease, which was escalating at 9% per annum, which we reset and signed for an additional 5 years. And the second was also a national retailer coming off of a 10-year lease, which also had been escalating well ahead of where the market rental was. We have forecasted for it and planned for it in our forecasted numbers. So it wasn't a surprise for us, but the reality is that the market really is perfect, and I'd rather take a slight reversion, to be honest, than sit with a vacancy, because the longer the vacancy sits, the less income we generate versus creating sustainable cash flows that you may have to just take a small reversion on. But in our forecasts, we also do budget every single lease that comes up for renewal and relet in a year. We actually put a vacancy allocation in it, irrespective of whether the tenant renews or not. So, and we believe that's defensive in nature, and that's the main reason why.
Great, thank you. There were a couple of questions that came in right at the death, but we're out of time, I'm afraid. To the team at Spear, thank you for your time, and the breakout room is closing now.
Thank you once again to everyone who participated in Unlock the Stock today, and a special thank you to Brad and Alan from Capital Appreciation, Quintin, Christiaan and Kim from Spear REIT for making the time to support this investor platform and to engage with the retail investors. We hope that you've enjoyed this event. And again, as a reminder, if you'd like to listen to it again, it will be on our Unlock the Stock YouTube channel. Please join us for the next Unlock the Stock session, which will take place on Thursday, the 24th of August with Barloworld. So please do look out for the invitation. Thank you, everyone, and goodbye.